Timing is everything. When and how funds must be handled. As we continue through Chapter 3, we now focus on one of the most common areas of violation in property management: timing. It is not enough to simply handle funds correctly. Brokers must handle them within strict timelines and according to clearly defined rules. Many compliance issues do not arise from intentional misconduct, but from delays, misunderstandings, or poor systems. Under ARS, Paragraph 32, 2151, brokers are required to promptly account for and deposit all monies belonging to others. In property management, where funds are received daily, this becomes a constant operational responsibility. The Broker Audit Declaration, BAD, evaluates whether brokers have systems in place to ensure these timelines are consistently met. This section builds directly on Section 3.2. Once funds are received and recorded, the next step is ensuring they are handled properly and on time. The 3-day deposit rule, immediate accountability. One of the most critical rules in Arizona real estate is the requirement to deposit client funds promptly. While specific timelines may vary based on contract or agreement, the general industry standard and a key compliance expectation is that funds must be deposited within 3 business days of receipt, unless otherwise directed in writing. This requirement stems from ARS, Paragraph 32, 2151A, which mandates that brokers must not delay the handling of client funds. The purpose is simple: client money should never sit unaccounted for or outside of a controlled environment. For example, a tenant in Tempe pays a $1,800 rent check on Monday. The brokerage must ensure that the funds are deposited into the trust account by Thursday at the latest, assuming no alternative written instructions exist. A common violation occurs when funds are held at the office, in a desk drawer, or by an agent for several days before being deposited. Even if the funds are eventually deposited correctly, the delay itself can result in a compliance issue. This ties directly into supervision. Brokers must have systems in place, such as daily deposit procedures or electronic payment systems, to ensure compliance with timing requirements. Excess funds and broker money. Understanding the limits. Trust accounts are for client funds, not broker funds. However, there are limited circumstances where a broker may maintain a small amount of personal or business funds in the trust account. This is typically allowed only to cover bank fees or maintain minimum balance requirements. These are often referred to as nominal funds, and they must be clearly documented, limited in amount, not used for any operational expenses. For example, a brokerage in Chandler may keep $200 in the trust account to cover monthly bank service fees. This is acceptable if properly documented. However, if the broker deposits additional funds to cover business expenses or uses the account for operational cash flow, this becomes commingling. Under ARS, Paragraph 32, 2151, commingling is strictly prohibited and is one of the most serious violations a broker can commit. Even small or temporary misuse of funds can lead to disciplinary action under ARS, Paragraph 32, 2153. The key principle is separation. Client funds must remain separate and protected at all times. Interest handling requirements. Who gets the earnings? Another often overlooked area of compliance is the handling of interest earned on trust accounts. Brokers must clearly understand who is entitled to any interest generated and ensure that it is handled according to agreement and law. In most cases, trust accounts are non-interest bearing. However, if an account does generate interest, the broker must follow the terms of the agreement with the client, ensure proper accounting of interest earned, avoid retaining interest unless clearly authorized. For example, if a property management agreement specifies that interest earned on tenant deposits belongs to the property owner, the broker must account for and distribute that interest accordingly. Failure to properly handle interest can be viewed as a misappropriation of funds, even if the amounts are small. This again ties back to fiduciary duty principles outlined in Jennings v. Lee, where brokers are required to act in the best interest of their clients. The takeaway is simple. If money is earned from client funds, it must be handled transparently and in accordance with the agreement. Owner disbursement compliance, getting the money where it belongs. The final step in handling funds is disbursement, ensuring that money is properly distributed to property owners, vendors, and other parties. Owner disbursements must be accurate, timely, fully documented. For example, a Phoenix brokerage collects rent from tenants and must disburse those funds to property owners after deducting management fees and expenses. These disbursements should follow a consistent schedule, such as monthly, and be supported by detailed accounting statements. A common compliance issue arises when disbursements are delayed or inconsistent. Owners rely on these payments, and failure to properly manage disbursements can lead to complaints and potential audits. Additionally, all disbursements must be supported by documentation. This includes owner statements, expense records, maintenance invoices under ARS. Paragraph 32-2151.01. Brokers must maintain records of all financial activity. If a broker cannot show how funds were dispersed and why, it creates a serious compliance issue. This is where everything comes together. Receipts, ledgers, reconciliation, and supervision all feed into proper disbursement. Bringing it all together. Handling funds in property management is not just about accuracy. It is about timing, control, and accountability. The moment funds are received, a chain of compliance begins. Receipt, deposit, tracking, reconciliation, and disbursement. Any breakdown in that chain creates risk. The broker audit declaration is designed to evaluate whether brokers have systems in place to manage this process consistently. A brokerage that understands and enforces these timelines will significantly reduce its exposure to violations. As we move into the next section, we will examine trust account audits and internal controls, where brokers test their own systems before ADRI does. Online discussion. Why is the 3-day deposit rule important in real estate compliance? Answer. It ensures that client funds are promptly secured and accounted for, reducing the risk of loss, misuse, or mismanagement. What is considered acceptable broker money in a trust account? Answer. Only a small documented amount used to cover bank fees or maintain minimum balances. Any additional use of broker funds is considered commingling. Why must owner disbursements be properly documented? Answer. Documentation provides a clear record of how funds were distributed, ensuring transparency and compliance with record-keeping laws.